Greetings, this is Dr. Jeffrey Scott. This is my weekend market update for May 22nd, 2022. I title this Next Leg Down or Time for a Rally. Email address, should you need to contact me, is hgsidoc@gmail.com. If you're watching this on YouTube, please hit one of the up or down thumbs on what you think. If you can like this, that's great. Subscribe. If you want to be noted when I post these, hit the alarm so you'll get a notification. All right, let's start with a disclaimer. This is for educational purposes only. Anything I recommend is really a discussion and in the spirit of education and should not be considered investment advice. I am a doctor, not a broker. Tools demonstrated those that I use in my daily trading. I've paid for all the tools I'll be demonstrating. And trading involves risk, and you alone are solely responsible for any decisions, investment decisions that you make. I'm reminded of this. This is based off of Stan Weinstein's work, and it's about cyclical patterns of stocks, indices, sectors, and so on and so forth. And it's important to also recognize that high growth stocks, which are typically what I've historically traded, although they're not working now, go up like rockets and come down like rocks. And you need to understand what stage you are in. So before I go forward, this is not a live event, so you can't really answer it, but answer to yourself. What stage are we in right now? Now, if you want to really know what stage we're in, you could actually take a major index, or stock for that matter, go to a weekly chart and put a 30 weekly moving average on that, simple moving average. And you could certainly suggest that if you are not above that moving average, that you are in stage 4 and you should not be trading that instrument, at least to the long side. More to follow. I also want to remind folks that I do these videos on a daily basis. I do a long video on the weekend for now, and I do short weekends that are published each morning on stocksanddocs.com, and I will also do a short version of this video and have it published tomorrow morning as well. In the lower right hand corner, you can see on the site, you could actually put your information there. I don't do anything with those except send out notices of events or if I've published something new. Let's go look at the markets. So for those that have been with me for a while, you know that I've transformed a lot of what I do. I've tried to make my life simpler. And one thing is I go with the same spreadsheet every week. I just update it instead of a large PowerPoint. So on the start are a number of major indexes. Number 12 is just sort of a index of the indexes. And one could see from this list a couple of different things. You look over 5 days, and what was the big leader? Natural gas. We've been talking about that for a long time. Bonds and silver. Commodities, interestingly, biotech. That's the one traditional bullish investment that's popped into that. Over the 1 day, you could see there was a little bit more green. Natural gas is actually down a bit. It was down more earlier. It is one of the more volatile instruments I've ever traded. And Bitcoin was down 4% on the week. More importantly, I like to look at this column right here, which is the current interval from the 52-week high. And you could see there's some really impressively bad numbers there. And for the most part, except for the fact that I screwed something up on the NASDAQ Q and it went to a number instead of percentage, which is 29%. Everything is ranked from what's held up the best: dollar, commodities, oil, natural gas, gold. Well, what does that tell you right away? It tells you that stocks are not working. And you could see Dow and Spiders down 15.4, 18.8. Spiders briefly touched bear market territory, which everybody was talking about on Friday. Russell's down 28, and NASDAQ's in full-blown crash mode, down 30%. If you want to see crash mode, take a look. Biotech's down almost 35. FANGs are down 40. That's a leveraged ETF, so probably overstating how much they're down. The IBD ETF, the IBD 50 ETF is down 43.1%. That's beyond wow. And you can see Bitcoin and ARK are leading it to the downside. Over here, you see these pink zeros, and that's just reminding me that those instruments, which include, frankly, everything but the Russell on the major market indexes, hit new intraday lows on Friday, and they bounced. You can see 2.9, 4.3, 2.4, 2% bounces off the lows. That's a big move, and that's why the second part of my title is there a rally coming this week. If one looks at the sectors, again, ranked the same way, you can see leaders are energy, utilities, and healthcare, and I would put those clearly in the defensive story. Energy, I mean, perhaps independent of interest rates, we're still going to drive our cars. And you can see discretionary communications down over 30%. And fresh new lows were set on industrials, the S&P 500, financials, and technology on Friday. If we look at the market health, looking at one way of looking at advanced decliners and breaking it out at sectors, industry groups, and stocks, you could see at the end of the day, Friday, it was a 50-50 day on sectors. 2/3 of the industries were down, but about 50% move on the stocks. If we look down here, we look at Friday, 2 days, a week, 2 weeks, and a month. As bad as Friday was, because of that reversal, it actually has the biggest slice of new highs on stocks in a month, industry groups in a month, and sectors in a month. So if you want to have some bullish feeling, there's your permission right there. Not that you need my permission. We'll talk more about the buckets in a minute. On the warehouse view, you know, we always cut out the stocks at the bottom and the top. Why? Because this gives you a list of the number of stocks. And you could see in the higher and lower ERG, EPS rank plus relative strength rank plus group rank, there are very few stocks. So if you look at the meat shows really nothing positive, and perhaps until the higher growth, higher ERG, really a flat to downtrending on gain versus ERG. And if you look at EPS rank, there's very few places to hide. Actually, high EPS was less bad than middle EPS, kind of what you're seeing in here. Relative strength rank, well, it was good if you had none, and it was okay if you were high relative strength. Really not much to learn from this. NASDAQ, I've added the bongo because every time we get into long-term trends, it reminds me how good the weekly bongo is of telling me where we're at. And the daily bongo will give me retracements in a downtrend, pullbacks in an uptrend against the longer-term weekly bongo. But until this starts to have green somewhere, you're going to have to really question whether any rally is more than just a retracement. When I look, you know, you're not going to see a Hindenburg again until you get to new highs, so probably it's 2024, 25 before that happens. And if we look down here, the most important thing that I'm seeing on the NASDAQ here is the number of new lows has dropped down to a percentage in the single digits. And if you just go back a week or two ago, you could see 23, 35, 20, 35, and now we're talking 7, 6, 8, 2, 5. That is improvement. It's subtle. It's way underneath. It might not be the generals. It might be the soldiers, the upstarts, the Affirms, the Roblox, stocks that have just been hammered might be showing a little bit of life. And maybe what will be the final moment for the NASDAQ before it turns around is the generals, the Microsofts, the Apples, the Googles, Amazon. Well, the Amazon's already killed. Will come down further before the market turns. If I look at sort of the scorecard here, you can see we are down another 3.8. I've got this off one. Oh, I hate when I do that. We're down 3.8% on the NASDAQ on the last 5 days. This is off one. Last close should be over here. And if you look off the 52-week high, we've now hit 30%. That's pretty ugly. If we look at the NYSE, same thing, weekly bond goes red. we're down to single digits. We were back in the week around the 9th, 25, 19, 25, 12. And now on the new lows, we even had one day where we got below 2% and the new highs perked up. So if I want to look for a silver lining in the dark clouds of the springtime thunderstorms here down in South Florida, or late spring, early summer, because hurricane season starts on June 1st, maybe there's a glimmer of hope. And we look down here, you can see that NYC was up on Friday, down 1.2 on the week, and is the least down of the major indexes, and probably because there's a lot of energy in that. If we look at the buckets, this is this week versus last week, nominally better, 74 versus 76, below the midline of their Bollinger Bands. In fact, you could even argue that it's a little bit worse with more stocks at below their Bollinger Bands. I'd say it's relatively flat, not bad enough that you have to see a bounce. Energy on the week, let's just talk about natural gas. Natural gas is up 177% year over year. I think a big driver of U.S. natural gas clearly is the Ukraine conflict with Russia, and it's the EU and others bailing on Russian energy. And then there was a agreement to supply liquid natural gas, U.S. to the EU. If you look at the move on natural gas in Europe, it's just bizarre how big for the year. But they have come down since that agreement was announced. So maybe we're going to meet somewhere in the middle. I am still long my natural gas positions. As I said, it's extremely volatile. You could see on the week, oil was up a little bit. Natural gas was up more. Coal had another good week. Gas and heating oil were actually down. Uranium was down. And as I said, ever since we signed that agreement with the Europeans, you could see pretty big down moves on natural gas. If we look at the metals and really look at the monthly here, all of them have been negative for the month. Year over year, gold is actually starting to be one of the better performers in the market, and that's only down 1.8%. Ignore the lithium, it hasn't moved in weeks. And then I just wanted to point this out. I've been talking a lot about Star Bulk, Zim, Golden Ocean, Eagle Shipping. There are a lot of dry bulk shippers that I've been in and out of, and mostly in. And one, be very careful. They pay huge dividends, and you have to figure out before the dividend comes out if they're going to adjust your option prices or not if you're in options. And if they don't adjust your option prices, you might wake up and be down 6-8%, even though you did nothing. And that's because of the dividend payout. If it's a special option, then typically they lower your strike price and it doesn't impact you. Why is dry bulk shipping doing well? Well, it's now up on the year. And if you consider all the things that are down after selling off in January, this is one of the best looking rallies that we have in the market right now. Interest rates came down on the 10 and the 30. Interest rates are the white. The yellow is the S&P 500, which obviously is rolling over. The fact they've come down is positive. The risk spread over here, credit risk, it's come up, and it's really one of the highest it's been in a while. We can see in the past it goes up and comes down. This is what happened in March of 2000. I think we need to watch that. And as the Fed is tightening, as it's doing quantitative tightening and raising rates, will there become credit risk in this market? And if that happens, what does that do to the stock? So I watch that. And then this is the credit spread, which probably doesn't matter anymore for this cycle. Stocks above the 200, stocks above the 40 are both coming down. And you could see, and I believe these are just the NYSE, but that's a very broad index. We have gotten much lower, low single digits in 2020 March. And if I went back to 8, 9, and 15, all the other different periods, you'll see it pull back. Now the issue will be, will we get down to lower single digits before this ultimately ends? Probably above the 40 as well. Still, it's back down Here's the March bottom, still ways away from that. 13-week new high, new low. This is probably my faster. And you are at areas where we have reversed in the past. We're at 4.17% new high, new lows, 13 weeks. You can get closer to zero. I mean, you could be days away from that if the market's soft. You could also see a short-term reversal here. This should be an interesting week, if for no reason, on the economic front, as there is a lot of economic news. You got PMIs, new home sales, you got durable goods. On Wednesday, you have the FOMC minutes. On Thursday, you got jobless claims, GDP or GDI, and then you get all kinds of inflation numbers, including the PCE, which we know is something that the Fed likes to watch. So big news week. If we look at earnings, we're not done yet. We still have another big week of earnings. You know, it'll be interesting to see what stocks like Zoom say, who were stay-at-home stocks that became out of favor. I can tell you down here in Florida, heck, inside my, sorry if I offended anybody with that word, in my house alone, we've got COVID issues right now, though thank God it's mostly minimal stuff. But will that change? Will the stay-at-home stocks get a rally? Will the COVID stocks rally, as we've seen COVID becoming more prevalent again, although it's clearly a different COVID than it was in the beginning. And then you look at some of these big box stores like Costco. Will it sell off like Target and Walmart, Big Lots? So there's still a lot to learn with earnings this week. Expected moves. I used to spend a lot of time on this. You know, I still do personally. I've been advised by several that I shouldn't teach as much on these, but I should more just talk about the market and save teaching for other times. And I've tried to do that to shorten the length of these to 30 to 40 minutes instead of 60 to 80 minutes. But I just want to show you, this is the spider. So the expected move is if you bought a straddle, meaning you bought the call and you bought the put and expected an outside move. So the person selling it, the smartest money in the market, the option makers, they price it so that there's probably an 83 to 85% time you're going to stay between the green and the red. So you opened up the middle line, the starting line is where you ended the prior week, and we traded up on Tuesday, big down day on Wednesday and Thursday. And I'm really just focusing, and I'm going to focus on it very quickly on the other indexes. Look at this bottoming tail on Friday. Where Friday we opened, traded much lower, and closed back where we opened, right on the expected move. So everybody, there was a push. Same thing happened here on, this was the spiders, this is the NASDAQ, this is the Dow futures. And again, big bottoming tails closing sort of in neutral, and then the Russell, which never really got below, but also had a big bottoming tail, and then a topping tail on the VIX. That's why I put in my title, maybe a rally this week. So here are my comments. We set intraday lows on Friday, Russell holding up the best. May not invalidate the O'Neill follow-through day. With what we're seeing in the market, but I don't see a whole lot of conviction for long. Another week of earnings is on tap. The markets now seem to ignore the ebb and flow of the Ukraine conflict. Fed minutes on Wednesday might give more insight into pace and amount of increases. Big week for economic data, and that's where I'm going to look for perhaps some of the answers that might stabilize this market. Are we going to see any evidence of inflation abating, or if not, does that make it worse? Late Friday recovery led to bottoming tails. I just showed you. I'm going to show you the dollar and the 10 years in a few minutes. They came down. It does feel like we might get some continuation to the upside after Friday's recovery. Considering, however, the dominant trend is to the downside, I'll be looking for new points to short, as I expected failure at descending, downtrending trend lines. On a review of over 1,000 charts, I do not see many good setups nor fresh breakouts working to the upside. Lots of interesting bottoming patterns. For me, to believe this is more than just a bounce before lower lows, I need to see these three things, the things in red, higher highs, higher lows, breakouts actually working, are not happening. Thus, any rally this week is likely dead cat bounce. Put in the back of your mind the markets likely will bottom before we think the Fed and the economy signal it all clear. Markets don't usually go up or down in a straight line. With 7 or 8 weeks down in a row for the major indices, one would expect a bounce before very long, and I'll continue to approach the market each day with an open mind. It's hard to see a quick fix here by policymakers in light of inflation, but data could temper those fears. China eased, but that is not typically a foreshadowing of rate policy elsewhere. However, markets likely will bottom before sentiment and economy turns. All right, now let's jump into the charts. So I like to spend time with one of them, and then we'll just generalize on the other. So let's spend time on the S&P. So if we look at the shorter term on the daily S&P, one could see that bottoming tail I talked about. This here is the 20% line, and this has been my target. We've talked about this. It also correlates with a Fibonacci retracement. If I go to the monthly, you can see that Fibonacci retracement, and it's all in the same area here. The red line is a retracement. We actually went and we hit that. Isn't that interesting? On the weekly chart, you get even a better sense of how this market has started rolling over and come down to support. The question is, where do we go from here? Looking at this chart, probably around 350-ish might be my next level of support. Let's hope we don't go down there. That's another 30 points on the spiders or 300 on the S&P. But it's not in line with what I've seen from other folks in predictions. If we go back to the daily, let's just look at a 5-minute chart. And you can see the rally that came in and took us from 380, remember, 3 up to 390-ish. And this would be in the lunch hour on Friday. Now, in my morning note, I took this, which I do pre-market, AVGO. I call this out as a potential short, and this is why shorts will kill you, because if you go to the open of the market, let's see, it's going to be right about here. Had a beautiful gap down, and a trade where the market was down significantly. If you bought it at the open, you would have gotten around 558, 559. The market traded down to 512. So a huge move, and it closed down on the day, but way off of its lows. It's just what happens when you get this rip your face off rally. So on that note, I think you got to be careful shorting here, because I think we're at a point where we're probably going to see a bounce. Now, when we talk about a bounce, let me make this one bigger. And I don't expect a bounce to mean we're going to new highs. Here's my first trend line that I'm watching, okay? And notice we set this top of this trend line on April 21st. So it wasn't the high of the market. The high of the market was back here. Well, it's back here in January, beginning of January. We touched this trend line on a rally up May 4th, May 5th, May 17th. And so right here, it's at about 398, about 9 to 10 S&P points above where we're at today. Where do you think, if we rally on Monday, the market's likely to stall? Well, I have probably 3 areas that I'm looking at as significant resistance. One, hold on a second, I want to go freehand. I'm abusing this freehand thing, by the way. So one would be in this area. Run up to this trend line and fail. Now, we've tried it enough. Maybe the 4th time we're going to break through. The second place, then, I'm going to look to fail. Let's assume this thing continues down here. This thing continues down here. Is there's probably going to be significant resistance here where the 50 and the trend line going back to March 29th began. And then, again, let's assume we get a nice little rally. This thing's going to continue to roll over. This thing's going to come down. And I'm going to figure the third big line of resistance is right here. So the way the market works, if we break out of this one, we're going to bounce around. And if we're really lucky, we'll run up here, we're going to bounce around, and then we'll go on here. Now, that's sort of the very bullish dream. I don't expect this to be a simple V bottom and the market goes up. But the first question is, and probably the most important question for this week is, do we go up here and go right back down, which has been the story? Do we go up here and do nothing and then break above, which would be short term, would be good if you still have long positions? With these three, what I think are dominant areas of resistance, are we likely to run up in a very fast bull run? No, we are not. But let me tell you, if we ran from here to 420 and failed, which would be your rip your face rally in a bear market, if you've got short positions, you're going to be wiped out. So you got to be very careful. And I consider contra ETF short positions. When we look at the Qs, the same basic pattern, the same as the diamonds. The thing that's held up the most is the Russell. Notice the Russell even has a daily bongo green. VIX, big topping tail. And let's look at the dollar on the weekly. Dollar came back. What have I been saying for days and weeks is I don't think this market really rallies until the dollar comes down. And part of that would be also the 10-year coming down. Not going to spend much time on the guppy charts, but you could see the most bullish thing about these charts, where we've broken down through all these major moving averages, is that eventually you get too far extended one way or the other and you bounce. And we've already bounced and had an EMS signal on the Russell. So I really think we're either at or near a point where we should see a significant bounce. It doesn't mean this is over. Gold this week had a good week. We took the 200. Silver way below the 200. Oil continues to be one of the more attractive things, riding up the 50 and still looking good. And as I said, natural gas can be extremely volatile. But boy, if you just go back to March 1st, when natural gas was less than 16, it's almost doubled in 2 months. Extremely volatile. 10-year, again, let's look at the weekly. You could see, like the dollar, it's come back. And that's a feel-good thing, but since inflation's gotten worse, I hope it doesn't mean something bad. Market theme, the overall trend is still large cap and value, although we did shoot down this week, giving some credence to small caps, but the longer trend, large cap and value. We look at the S&P 500 sectors intraday, and what you could see, if you want to find strength, look for the upper right-hand corner. Materials, coals and materials, ore started moving a little bit this week. Energy, nat gas, oil, all kinds of things in the energy complex. Some of the royalty trusts, which I always have a hard time understanding. I remember people used to try and sell me them, and you got a tax break, and then they would disappear after so many years. There's publicly traded royalty trusts that pay massive dividends. And then look at healthcare. Now, what should be up if we're in a defensive play? Staples, utilities, and real estate, and they're dragging right now. So I'm going to go into the premium dashboard, and let's just take a look at the S&P 500 from a heat map, and you could see a lot of the generals were red. In fact, the only general that was green was Amazon, and it was up a nickel. So despite the big reversal move in the major indexes, the generals, I guess Facebook's probably been demoted to a kernel, but it was up 81 cents. If we go into sector scanner, now I've had some people ask me, well, my numbers, your numbers, they look different. Yeah, I'm not within WealthCharts itself. I'd be pretty shocked if our numbers look different. However, within compared to the S&P 500 or 1500, of course they'll look different. I've got 2,000 industrials alone, so we're looking at a much broader market. That may be good or bad, but I don't know if I'm thinking it's a good thing. But worst case scenario is it's the same. It's just going to be, as far as meaningfulness, you're just going to have different numbers. Now, what I like to do is I like to pick the best industry groups right now, and they could be by one-day move, it could be by weekly move, it could be by algo. So let's look at each of those. So I could take real estate. I'm looking at the algo scores. Let's go to daily algo. So I would want energy, utilities, and basic materials. Let's look at weekly, and let's add healthcare. So let's just look at those four. All right. I picked the daily ones based upon the only three that are green. And then because healthcare seems to be coming up and it led on the weekly, I decided to pick healthcare as well. With those four sectors, if I hit compare, I bring up the industry groups that are in those four sectors. I go daily percent change, and let's just go for the ones that are positive. And now let's open that up. Let's look at the algo score and make sure I pick up any of these that were missed on the daily percent that have good algos. All right. And then let's go over to the weekly. And there's no rhyme or reason. I just have my way of doing it and just filling in those that had good weekly numbers that may have gotten otherwise missed. There's a lot of industry groups, so I'm not taking too many. Now I'm going to hit compare. And what I've done here is I've pulled up a list of some of the best stocks. Now, I think at some point I'm going to go into this watch list, and I don't want to have daily percent changes more than, say, 20%. And the reason for that is because you get a lot of these teeny-weeny stocks that had massive moves, and you go look at the stocks, and they're like 10-cent stocks, 30-cent stocks. So let's just take the top of this group now, everything that was up more than 3% on Friday. I mean, if I'm looking for things that are bullish, I probably don't want things that were down. And if I hit the shift key there, and then let's just go in here and let's look at the daily algo and see what things I'm missing. And you can come through here if you want, and you can pick out the things that have the best daily algo. I recognize so many of these. We're just going to pick this, fill up this sheet. And then you've got to identify what is going to be your bullish and bearish watch list. So we're set at, since it's Sunday, I like to go to I've already started populating this. This is my broad bullish top-down watch list. I'm going to hit apply. I have a bearish one that I built the same way, but I'm not going to look at it right now. Why? Because I'm trying to keep this under 40 minutes, and I'm probably going to fail at that. If I go into Wealth Scanner, there's a number of things I could do. I like to put a series of my top-down indices in here. I may be looking at updating that and making sure I've got all that I want in there. This gives me, and I just look at the time frames. I'm not looking at weekly or monthly. I'm not looking at 2 minutes, and I'm set for a swing trader. So it's fast, but it's not the fastest settings. And lo and behold, shocker alert, natural gas continues to be up there. Gasoline, the dollar, short bonds. Then we get commodities, USO, oil, production, energy, short the Q, which had been working extremely nicely. In fact, it looked as good as natural gas. But this may not be some place that you want to hang out if we see the markets rally. PPH, I'll point out, big pharma. It hasn't broken above the 50 on the ETF, but the fact that it's made this list is something to pay attention to. Now, as was pointed out, one simple thing I could do is just go to my weekend review and pull out the stocks that have the best scores, and that could be a shorter way. And I do this, International Seaways, and I'll just go through. Southwest Gas is what I'm looking at. It's another play on the gas story. So there's a lot of good stocks here. Phillips 76, Hudson. Now, this is going to show me the best stocks in the market right now. The challenge with the best stocks in the market doesn't mean that they're necessarily at the best buy points. VTNR is one we've been looking at a lot lately. It's got earnings, I believe, on Monday. It's come down off of its highs. So this is certainly a great way of understanding what's working. I designed my CAT scanner so I could put that weekend review in here. And this is set up as a bullish scan. So I'm looking for a price and volume of 5 and 500,000 shares, at least one bullish dot. And I've turned everything else off for now. And let's go back and let's just rank them by number of dots. And this will be pulling up the stocks that are some of the more bullish stocks. As I went through the market, let me show you some of the ones that I thought were interesting. Pfizer, old name, pays a dividend, probably in the 3% range. Why I like this, and this would probably be one of my favorite stocks of the in the market right now. Weekly clearly shows me we're in an uptrend and we pull back. Check. You know I like pullbacks and uptrends. The daily showed on Friday it broke above the 50-day moving average with a big volume, a breakout momentum. It's in a squeeze. Look at how strong relative strength is versus the spider as an OBV turned up, and at 16.4 it is not extended. So if you're looking for a stock you can probably look at, and again, this is not investment advice, it's education, but you might want to be looking at right now, it's Pfizer. Novo Nordisk, I don't know this company, it's not an oncology company, and it's below the 50, so I'm less interested. Why am I interested? Because it showed up on my list, it had a gap up, closing at the top of the gap, which is very bullish with momentum and a breakout. Look at, again, the relative strength, the OBV, and it's not extended. Because I had a family member called and asked if I had any contacts there, and I go, no. Why? He goes, well, you know, Lilly advertises they have this new diabetes drug that causes weight loss. And apparently Novo Nordisk has a same drug, different dosage perhaps, and it's not for diabetes, it's for weight loss, and it works. So imagine what a weight loss pill that works is, especially after we all got our COVID-20. It's just like going to college again. My friend Kathy sent me a note about SIGA today. You could see it made it in the top group on my top-down review here. And SIGA had a huge move, a gap up on volume and momentum, and this is a monkeypox play. Now, under normal circumstances, news like this, typically the pattern, then it peaks and it comes right back down. You wonder if it's going to be different this time because of the COVID mania that we've been through. Other things on this list that I wanted to point out: Anthem, a commercial payer, managed care, beautiful chart here, about to take out the 50 and the 17 with a high volume breakout momentum from a squeeze. That looks interesting right here. I guess that's enough on the long side. Lilly is one that I liked as well last week, and it popped, it came back down, and frankly, just like Pfizer, Lilly looks like it's setting up to continue its run. Now, I'd have to be a fool to concentrate and only think bull, 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 bull here. I do think short term, that's not foolish. But the way that I make my trades is that's got to come to me. I set a buy stop typically above the high of the day. So if the market opens lower, I never get filled. The only time I get hurt is when the market opens and then trades up, I get filled, and then it tanks. That's why you have protective stops to the downside. But let's say the market doesn't rally and we get that next leg down. Then I want a bearish search. So I've got my weekend short review here. This scan is set up differently. I'm looking for a higher price stocks. I'm not sure that that's necessary. Maybe bring that down to $35. And at least one bearish dot, nothing else. And I put the bearish weekly bongo in because I want stocks that are already in established downtrends. So let's look at rank by dots, and let's look at AGCO. What is the purpose of having a scanner? The purpose of having a scanner is so you can identify the type of stocks that you might be interested in going long or short and getting them to give you a list that brings the stocks that meet your criteria up to the top. So why did I like AGVO on Friday morning? I liked it because it broke through the 200 after it retested. AGCO, agricultural plays, they've had a big run. It's probably tough to short leaders, but this is already broken down. It ran back up to the 200. The data short was probably on Thursday or Friday, but if it takes out the low here, this thing has run a long way, okay? I mean, we're talking a long way with this run up. So maybe this might be a decent play to the short side. Why do I like it to the short? Because it ran up to the 200 and broke back down. It's already in a downtrend. So retracement, you can see how the daily turned green. The weekly is in a red. It got up to the 200 and it broke down again. And you can see the opposite of the bullish, the breakdown of relative strength and volume. AIG is another one that looks interesting. Again, another stock that if you look at the weekly has had a huge run up, and if insurance, mortgages, here's your breakdown. Now, what I'd like to see ultimately is for it to trade up to the 200 and break down, but this one failed at the 200 after breaking below it the day before. This is another one that has a pattern. Burlington, boy, this is in that complex of the big box stores. This thing is, look at where the 200 is. I probably wouldn't short this stock right here, and at 87, net minus 87, this stock is getting to extended to the downside. Caterpillar. So people ask me, why did I create the CAT scanner? Why did I want to start working with WealthCharts? What changed in my life? You just saw it. I just ran two scans, a bullish scan and a bearish scan. I ran them against a bunch of stocks that are in my bullish or bearish list respectively. And right off the bat, each one I go through are very strong candidates based upon the criteria. Look at Caterpillar, big move up, clearly broke down, kind of getting into double top land, broke below the 200 here. Does this stock look like it's going down? It does to me. Does it mean it's going down? I don't know what the market's going to do on Monday, and this isn't investment advice, but what I've tried to do is work with the team at WealthCharts to create a tool here, added on to their wonderful program already that gives you insight and opportunity to hopefully survive in the challenging markets. So on that note, I want to say goodbye. Have an outstanding week. Please remember that if you like this, to go ahead, if you're still here, and hit the like and subscribe and hit the alarm so you get notified. And if you want to hear more of my rambling, stocksanddocs.com. I'll put that in the remarks section in YouTube. Have a great one. Thank you.